Welcome back to Store University Lesson 1, How to Value a Business. I'm Chris Folk, CEO of Store Capital. In the first two segments of this lesson, we discussed the importance of understanding the needs of the seller and then how to calculate the cash flow of a company that you intend to purchase, which is to estimate corporate EBITDA, or earnings before interest, taxes, depreciation, and amortization, while also incorporating the cost of normalized annual capital expenditures. Now, we're ready to move on to step 3, which is how to determine how much you can borrow against the business you'd like to purchase. Actually, it's more than that. Determine the amount of other people's money you can use to acquire the company. I use these words intentionally. Other people's money, or OPM, is a finance versus an accounting term, and it comes in many forms. You can get term debt secured by assets. This is debt mostly from banks and other finance companies having a scheduled repayment over time. Or asset-based lines of credit. These are credit lines, again, mostly from banks that are secured by inventory and accounts receivable. These borrowings are generally allowed to be interest only because the source of payment is viewed by lenders not to be free corporate cash flow after interest expenses, but the conversion of the assets, which is inventory and accounts receivable, into cash through the operating cycle and cash flow of the company. ABL facilities are appropriate where the portion of assets centered in accounts receivable or inventory is much higher. Then there are real estate mortgage loans. If the business needs real estate to operate, then the real estate may be financeable over a long period of time since it is the longest lived asset. Lenders may include banks or insurance companies, to just name two. Real estate loans may be included in term debt above, but typically bank term debt is secured by furniture, fixtures, and equipment, and perhaps by accounts receivable and inventory. Next, there are real estate leases. If the business needs real estate to operate, then leasing real estate is another option. This is a big part of what Store Capital does for our customers and is valuable because it's fixed rate, it replaces both borrowings and the equity needed to purchase real estate, and has the lowest payment you can generally get from other people's money. Then there are assumed borrowings. There may be some borrowings at the company that are just worth assuming, or perhaps there are borrowings that cannot be prepaid and need to be part of your capital structure. Then there's seller financing. If sellers are willing to carry back financing, this can be a great way to finance a company because such financing is almost always unsecured, it's generally subordinated to other borrowings, and it's viewed by banks and other sources of capital to be like equity and it's interest only. Now, I should add here that there may be other such sources of junior capital or mezzanine capital out there from friends, family, or various specialty lenders. The goal with using other people's money is to finance assets the longest and with the lowest payment constants. Now, a payment constant is just the total payment as a percentage of the amount of capital to be received from OPM. For a loan, it's interest and principal divided into proceeds. For a real estate lease, it's the payment divided into the proceeds received from the sale of the real estate. If you look at private equity firms as proxies for selecting the most optimal financing structures, devices like real estate leases and ABL facilities are amongst the most favored because of the comparatively low payments required and the attractive advance rates. Evaluating options takes time and effort. The lower the payment constant and the greater the proceeds from other people's money, the more you can pay for a company. Or another thing, given a known and fixed valuation offered by a business seller, the more money realized from OPM, then the less capital you need to invest yourself into the business. The amount of OPM you will be able to use will be driven by the underwriting standards of the entities providing the capital. And such standards are not always standard, which means you have to shop a bit. One thing to remember though, capital sources will tend to look at historic performance and they will discount any projected improvements, which means that you should too. Now that you can understand the concept of other people's money, you can better evaluate your financing options to purchase a business. That is, you first shop to determine your alternatives. Then if you're looking to achieve a prudent capital structure, you will generally want to achieve a balance sheet that provides you with the most money with the lowest payment constants, permitting the most free cash flow after serving your OPM obligations. This will provide you with the greatest margin of error, together with a reasonable business valuation. In our next lesson, we'll turn on how to value cash flows that remain after valuing other people's money. And until then, I'm Chris Folk, thanking you for joining me on this valuation journey.